Hello and welcome to our discussion on the preparation of the consolidated balance sheet. In this session, our focus is on intercompany owings because the consolidated balance sheet presents the balance sheet of an economic entity, not an individual independent legal entity, and the consolidated balance sheet shows the holding company, the parent company, and also the subsidiary company, all the assets and liabilities. So the issue is whether it makes any sense to have intercompany owings like debtors, creditors, bonds within the companies on the consolidated balance sheet. The accounting standard says, related to consolidated balance sheet, that intercompany owings should be eliminated. Let us understand that with this example. The assets and liabilities of A are given, and the information is that A acquires 80% stake in B for 35,000. That means the purchase consideration is already given here, and purchase consideration is discharged through cash. And there's an additional information that one of the bondholders of B is A Limited, and debtors of A includes 8,000 due from B. So this is what is the the intercompany owings, because one of the bondholders of B is A Limited and one of the debtors of A is B. So what is the treatment of these two items on a consolidated balance sheet? According to the accounting standard, as I mentioned, the intercompany owings, intercompany owings should be eliminated. Should be eliminated. So let us go to the Excel and understand that. So it's the 80% stake A acquires, so therefore A's stake is 80%. A's stake is 80%. And the minority interest is 20%. And there's an intercompany owings in the form of debtors and bonds, and the purchase consideration is already given. Purchase consideration is already given as 35,500 for 80% stake. So it's not required to calculate in this example the purchase consideration. And the purchase consideration is also discharged through cash, so 35,000 is discharged through the cash. But to find goodwill, we need to find equity of B, and equity of B is the assets of B. No information about the fair value, so we assume the book value to be the fair value. So I'm just adding all the assets minus the liabilities of B. Then liabilities of B is 10,000 plus 11,000. So the equity of B is 47,500, and A acquires 80% of that, and that is A's share, and the minority interest is the balance amount, that is 20%. And we'll use this information to calculate the purchase consideration, calculate the goodwill. Goodwill is the excess of purchase consideration over the equity acquired, and equity acquired is 38,000. So in this example, the goodwill is a negative goodwill, minus 2,000. That means to acquire 38,000 worth of equity, you are paying 35,500. So there is a negative equity. There's a negative equity. And with this information, now we can prepare the standalone balance sheet. The standalone balance sheet will show the creditors, the bonds, the long-term loans, no change in the capital, no change in the reserves. And however, cash will reduce to the extent of 35,000. Cash will reduce to the extent of 35,500, because that's the way we are paying money to the purchase consideration discharge. no change in the inventories, no change in the bonds, no change in the debtor, and no change on the plant, and B's share will appear as the value of the investment in the books. So the standalone balance sheet of A will have the investment in B share and the corresponding payment in the form of reduction of cash. Now let us see the consolidated balance sheet, and that is where, while preparing the consolidated balance sheet, you have to remove the intercompany owings, or in other words, eliminate the intercompany owings. So the creditors will be 32,000 plus 10,000 minus 8,000. The bonds will be 0 plus this minus 5,000 because that's an intercompany. The loan, no change in the loan. Capital, no change in the capital. Reserves, no change. And the minority interest will appear. Similarly, cash 14,500 plus 3,000. Inventories 9,800 plus 27. Bonds 5,000 minus 5,000 because that's the and the debtors, the debtor will be 40,000 plus 5,500 minus 8,000, and no change in the plant, and B share will not appear, and goodwill will be 2,500, and that's the balance sheet. So if you observe the intercompany owings, you can see this here. Intercompany owings reduces the debtors to the extent of 8,000, and the debtors here will reduce to the extent of 8,000. Similarly, the bonds will reduce on, and the bonds assets will also reduce in the consolidated balance sheet. So this is the effect of the principle of the consolidated balance sheet given in the accounting standard, that the intercompany owings should be eliminated while preparing the consolidated balance sheet, because the consolidated balance sheet is the balance sheet of a combined entity or a combined reporting entity. So these items which are due to or due from each other should be eliminated. Thank you very much.